Good afternoon or good morning, as the case may be. We welcome you to this webinar. We're presenting on behalf of the National Council of Firefighter Credit Unions in cooperation with that wonderful organization, NCOFCU. I'm Dr. Randy Thompson, the CEO of TCT Risk Solutions located in Eagle, Idaho. And today's topic is going to be, what is the major threat, as you can read on the screen, to credit union success? This is as I see it, as we see it, some things we've been studying for this last several years, actually for the last about 15 years, and want to bring to your attention just for your consideration. All right, as we go through this, we're going to have very specific sections. I just want to talk about, as we'll go through, the first area is just kind of a review of what is a successful business? What are the practices that make business successful? If you think about it, there's not a successful business out there that doesn't have a strategic clarity, doesn't have these things. They know, one, why they're in business, what their purpose is. They know who is the strategic focus, their target market, who are they after, who are they targeting, who can they provide the most benefit to in that general marketplace. They also know what they offer to that target market that's valuable and motivates them. That's their value proposition. And we also know what their unique advantage, their unique positive in delivering their strategy and their value proposition way better than others, which is their competitive advantage. All of us know these things. Let's dig into them just a little deeper, though. Based upon this, at the core, at the very base core of what every credit union does, every successful business or credit union does, is one, produce a product in a cost-effective manner. Now, this is the same whether it's a production company or a service company or a sales company or a wholesaling company or a consulting company, whatever it is, they produce some product, from a set of tires to a bakery item to a strategy that can be used by a consumer, by a company to succeed with their consumers. But they produce a product and they sell that product at a price that covers the cost of the goods and provides a fair return to the business. That's the heart, that's the foundational part of any successful business. In order to do this, we expect that the net revenues from our product, from that product sales, that primary thing we provide, which is gross revenues minus cost of goods sold, will cover the product, production of the products and the delivery of the products, and be sufficient to provide us with some sort of return or investment. Now, if we focus on credit unions, the core product of a credit union is loans. Different kinds of loans. We're not investment unions. We're not deposit unions. We're credit unions. Credit unions were organized all those many years ago over in Europe, initially to provide loans, give access to loans to people who couldn't get them from banks. So our core product is not investments or deposits, it's loans. And the raw materials we use for those loans are deposits. See, I would suggest to you that deposits are not a product. They're the raw material that allow you to go out and make the final product, loans, that you're in business to do. Production costs are our operational expenses. You remember we said that we want, in the previous slide, we want our sales to generate adequate revenue to cover the cost of the raw materials and the production costs or operational expenses. Okay, so next topic I want to go, building on that core identity, I'd like to understand and introduce you to the concept of net fee subsidies. All right, this is an example of a vital signs, credit union vital signs form that our company, our QCell, provides. After many years of multiple regression analysis and other types of statistical analysis, we were able to identify 17 key indicators. 4 of them are primary, actually 5 of them, that are just like blood pressure to a human individual, to a human body, or temperature, or respiration rate, or heart rate, there are core indicators of how healthy your body is. These are core indicators of how financially healthy your credit union is. And you'll see up here towards the top, there's equity and loan to share and so forth. But I'd like to direct your attention right down here. If you remember, one of the core assumptions that we said earlier was that your net revenues would be enough to cover operating expenses and provide a return to the business. That is no different for credit unions. So what we have here is net interest margin, which you'll see with this credit union has been gradually increasing or steadily increasing from 21 to 22 to 23. That is, as a ratio, it is total net interest margin, interest income minus interest expense divided by assets, so that we can create a ratio that's comparable across any size credit union. Then operating expenses, total operating expenses, which have been increasing as well over those 3 years. And then we subtract the operating expenses from the net interest margin. And that shows us that the net interest margin here is inadequate to even cover the operational expenses of this credit union. They need 12 basis points as a percentage of assets just to break even. That is what we call a net fee subsidy. And in this case, this negative number indicates that this credit union is fee dependent. If they don't generate a certain amount of fees, they'll operate at a loss. They're not even covering the cost of operations, the production of the product. So let's just look at this formula again. The formulating the net fee subsidy are interest income minus interest expense gives us our net interest income. Okay, that's the first net. Net interest income minus interest operating expenses equals our net fee subsidy. Now, here's what we're suggesting, and I'm just going to kind of walk you through. If net interest income is less than operating expenses, both again as a percentage of, well, it's our measurements of percentage of assets, then fee income is needed to subsidize operating expenses, not to generate income, bottom line profit, but just cover operating expenses. Imagine if we had a business that had to have some sort of outside fees just to cover the production of the tires or the wood products or the bakery goods that are being produced in a bakery. If net interest income is equal to or greater than operating expenses, then all fee income flows directly to ROA and equity. Now, I'm not saying we shouldn't have fees. What I'm suggesting is that fees should not be a substantial provider or supporter of our operating expenses. So we expect that net revenues from product sales will cover sales and production and cost of product delivery. That's what we're trying to look for here. That's what we're looking at. And this is something that banks have been talking about since the 1970s. So let's just take a look then. We had a seminar earlier this year, and there were a number of credit unions there, and 17 of the 27 credit unions were net fee negative. They were fee dependent. And we were able to pull numbers from their 5,300 and showing that they went anywhere from a negative 1.42 of assets fees dependent down to 0.03. So you can see ranging components of that. I want to focus just on this one. This is an $862 million credit union. All right. They generated $19 million in fee income, but their net income was only 7.6 million. They needed $12.2 million of fees just to cover operational deficiencies, the inadequate loan interest, net interest income to cover the operations of their business. $12.2 million subsidy. Let's go down to this $4 billion credit union that needed 24 million, almost $25 million of fees just to break even. You can see these are pretty significant numbers, and there's 17 of them here. Now, the other 10 range from a positive 10 all the way up to a positive 82, which means that this $8 million of net fee subsidy all flowed to their bottom line, plus some of the interest income that flowed as well. As a matter of fact, these 10 credit unions could have turned this profit level here without charging any fee income. So what's the difference? I mean, what's causing this? What's doing it? So we had, as you can see here, 27 credit unions in this initial study. 17 had net fee subsidies, 10 had no net fee subsidies. So a larger percentage. We did a subsequent study with a national base, and we found about 118 credit unions that were involved in this study. 61 had net fee subsidies and 57 did not. Closer to a 50-50 here. But still, this number here is troubling to me. So let's just take a look at this. Remember, the net fee subsidies range from 3 to 1.42 in the first study. In terms of dollars, that's anywhere from $23,000 shortage that had to be covered in fees to $12.2 million that had to be covered by fees. While the credit unions here, they had 62,000 up to 8 million of excess interest income after paying for all of their operating expenses. Now, in the subsequent study, the bigger one, their ranges went from 0.01, almost breaking even, to 1.46, which means that one of those credit unions had to generate $14.5 million of fee income just to break even. Pretty heavy load to carry. While on the other side, there was one credit union that generated $9.4 million of excess net interest income before fees even came into the picture. How do they do it? Well, if we look at this impact, my analysis, looking at this over the last, 15, 16 years, suggests that there are four principal causes. One of them is being corrected, has been, and continues to be corrected, number 4, but the others are still there. One was irrationally low core interest rates on loans. We'll take a look at that as we go. Very low interest rates. Number 2 was an avoidance of higher risk and thus higher yielding loans. After, as you're going to see, I used 2010 as kind of a starting point for the analytical analysis we do. You'll see that in a minute. The 2008, 9, and 10, the debacle, the financial downturn we had, really pushed credit unions to move away, become quite risk adverse, and a number of our regulators pushed that as well, saying don't make loans under a certain level, even though NCOI guidelines urges credit unions to reach out and make loans they would otherwise avoid. We found that 90+% of all the loans being made by a large number of credit unions were in the A+ and A tiers, with the highest rates, which were at that time irrationally low. We also saw low loan-to-share ratios, which meant that a large percentage of the raw materials were being used for investments with historically low yields. Now, this is being corrected, but that's out of the control of the credit union. These things up here, these are totally in the control of the credit union, and we're going to talk about just how you can turn this around and become part of the group with a positive net fee relationship. Okay, so let's talk now about how those that net fee subsidy, the rates, those things we just talked about, impacted credit unions over the last 14 years. So for 2 decades, credit unions reduced rates on loans dramatically while they all competed for a diminishing share of A+ and A loans, just like we said. That's for almost 20 years we've been doing this. Because this goes back even before. Now I'm using 2010 as a starting point for comparison. If you look at here, we did a survey of a different 75 credit unions from across the country. And what we found was that the average A+ rate on automobiles, we're looking at autos here, the average A+ rate was 4.62 in 2010. By 2013, just 3 years after the debacle, economic downturn, the A+ average rate had dropped 2.01. Now, you might say general interest rates came down, but costs didn't, as we're going to talk about in just a minute. Salaries didn't drop, rents didn't drop, computer costs didn't drop. The operating expenses of the credit union stayed fairly consistent. But that was a drop of 2.61. Now, if you'll notice that, the reduction amount is significantly higher than the remaining interest rate. Now let's take a look at what impact this had on credit unions. As they were doing that, you'll see we have credit unions ranging from almost 200 million down to 10 million in this study. This credit union here with 129, almost $130 million of loans in their portfolio, they had an average yield in year one, which was 2010, of 5.57. By the end of year two, 2011, their yield had dropped from 5.57 to 4.71. That's a reduction of 86 basis points of ROA. That, against that balance, is a reduction of $1.1 million of revenue in 1 year. Let's go down to the $200 million credit union, which dropped from 816 to 729. And by the way, these drops just continued. So this wasn't just a one-time loss of revenue. This was a revenue drop that remained and then was increased as the rates continued to come down based on those focus on A+ and A loans with very low, irrationally low interest rates. This credit union, this 200 million, reduced over $1.7 million in interest revenues, 1.6, 1.1. You can see the significant numbers. And even the small credit union had a reduction of 104 and change in revenues. Now, the impact on that is obvious. See, irrationally low interest rates, avoidance of high-risk loans, and loan-to-share ratios had that big impact. And if you look at it, if we have low loan yield of 5.66, sounds good. This credit union has a 26% loan-to-share, which means only 26% of their raw materials, their deposits, are earning the 5.66, and 74% is only earning 1.79. Now, what was operating expenses? I'm earning 1.79 and having to pay 2.64. Doesn't work. That's where we end up with this net fee subsidy. So what do we do? Well, let's take a look at now how we can turn this around. We understand what the problem is, I think. Let's see what we can do to turn it around. So we're primarily talking about credit risk, obviously, being risk averse. We're also doing a little bit with compliance, a little bit of strategic risk. You know, that strategic risk is our decisions and proper implementation will reduce our earnings and net worth. I'll be darned. We are talking about strategic risk here as well as credit risk. So let's talk a little bit. Credit risk is defined, we'll go back here just for a minute. The risk that your credit union, the risk of non-payment or non-repayment where your credit union invests or loans funds. Non-repayment. Typically, we think about that as losses on loans. loss on principal. Now, I would like to suggest that there are two components, two distinct and different components to credit risk. One, as we've just looked at, is extended risk, what I call extended risk. And that's the principal that you've extended to the borrower, the risk that it will not be returned. And we watch this like hawks in credit unions. In credit union land, we do reports constantly. We're watching those things. We're reporting to the board. We get approvals for principal charge off, and we try to recover it. We're really good with this. But I also would suggest to you that there's this other component, which is expended risk. Expended risk includes cost of funds, loan operations, collection expense, all those costs that we have incurred getting these loans on the books. If we do not charge adequate or charge an adequate rate to receive an adequate amount of interest income, we may find that what we're receiving is inadequate to cover these costs. Think of the $12.2 million of subsidy that was required by one of the credit unions we looked at earlier. So what we're suggesting that if I like this definition for enterprise risk, we need to assess, control, exploit, and finance risks. And those are both kinds of risks, expended and extended. We need to exploit expended risk. We need to finance and monitor so that we maximize the value of the credit union to our members. So let's talk about the two just in more detail. In 1995, NCUA issued guidance letter 174 that authorized and provided guidance and best practices on doing risk-based lending. And here's some of the things they said. They said risk-based lending allows a credit union to assess risks and involved in different types of loans and to understand the inherent risk. They said the end result is a more diversified loan portfolio. Now, this is not diversified. They're not talking about diversification by product type. They're talking diversification by risk level. You see, they say mixing lower yielding, lower risk loans, which is what I told you, we're getting 90+% of those in the mix, with higher yielding but riskier loans. Well, let me get this straight. NCUA is actually encouraging me in their guidance letter to find and make higher yielding but riskier loans. They say the key here is to have the board determine the exact parameters for the riskier loans. And that may be a discussion for another day where we talk about Johns and Henrys. Henrys are on their way down, Johns are on their way up, and differentiating. The key here, again, somewhat higher borrowers, as well as this will allow us to better serve somewhat high risk borrowers, as well as better serve their more creditworthy member, somewhat riskier borrowers. And it says we need a tiered pricing to be able to do it appropriately. Different rates for different risk levels. And this is what I wanted to show here. Back in 95, they told credit unions risk-based pricing or risk-based lending should not be used as a means of repricing the existing balance sheet, but as a tool to reach out to the underserved and make loans take a risk that might otherwise be avoided. Take risks that might otherwise be avoided. Okay, what we're suggesting is that there's a tiered, here's an example of a tiered approach to extended risk, where we say these are the parameters that are typically in a credit union's policies, probably in a bank's policies as well. They're all pretty similar. 1 year on the job, maximum debt to income, maximum unsecured debt to income, 2 years of clean credit. And if you've got all this stuff, we'll loan you up to 8 years, up to 120,000 miles on the car, all this criteria. This is our best loans for our best members. And then we typically say everything else is an exception to policy. But what we suggest is we can actually get down here and say, What about the people who are rebuilding? What about the guy who lost his job, went through some credit problems, but now is repaying those old debts, has been 90 days on the job, has kept his unsecured debt to income ratio low? This is one of the key differentiators between a John and a Henry. Someone who's headed towards charge off and someone who's headed towards better credit standing, that low unsecured debt ratio. Notice 6 months now that they have been delinquency free. They haven't had 2 years of experience yet, but they're on their way. In this case, we may choose to make a car loan up to $20,000 for no more than 5 years with some down payment. Going longer is typically just a way to help a person get into a car that they just can't afford. But collateralized loans and perhaps small unsecured loans can help them rebuild their credit. Okay? Risk-based lending philosophy does not intend for a credit union to grant bad loans. I still chuckle about that statement. Nothing is intended for us to make bad loans. But what do they really mean there? Well, let me give you, I mentioned Henrys and Johns, so let me just talk to you a little bit about them. Henry, we've found that there are 4 distinct groups of borrowers at any credit union. And the 2 I want to focus on now are Henrys and Johns. Ruth's, the ones we talk about, are stable. When John first came to the credit union, he had an A+ credit score. And he's been an A+ borrower for years. We've loaned him money for cars and boats and vacations and homes and toys. But several months ago, he lost his job. And he didn't want to change his lifestyle. He's used to a very, very comfortable, fun lifestyle. So he started living off his credit cards. And his probably had 4 or 5 in his wallet from different places. He also has a backup line of credit for his checking account. And what happens is he's living off those, and that unsecured debt increases. And what we found in our 15 years of doing this, actually 16 years now, our analysis is that about 60 to 80% of all charge-offs come from Henrys as they finally run out of unsecured credit, have not found anyone else who will make consolidation loans for him, and now they declare bankruptcy or just stop paying and have to have everything charged off. John, on the other hand, was a stable member of the credit union, doing great, but he lost his job, and his wife had medical expenses that put him under. We know that 69% of all the bankruptcies in this country are linked to medical expenses. Huge number. So his credit score dropped to D, but his wife got better. He got a new job, and he started paying back his old debts, saving $1 or $2 as he went along. And his credit score has now come up to A, where Henry dropped from A+ to D. John has come from D back up to A. Very different. We want to loan to as many Johns as we can and avoid Henrys like passion. So, risk-based lending philosophy, what I believe NCUA meant to say was, it is not intended for a credit union to grant Henry loans. Understanding credit migration and the movement of scores is crucial to good management. You see here, as I give you an example, here's Henry. He received a $9,000 limit on his credit card way back in 2004 when he had a 753 credit score. Today, his credit score is C. And just 3 months ago, he didn't owe anything on his credit card. And looking back, he did run that up to $9,000 and file bankruptcy, and the whole thing was charged off. Now would have been the time to reduce that limit to $4,000 and eliminate exposure to $5,000 of probable loss. On the other hand, this John, with an increased credit score up to A, the Credit union contacted him, offered him new loan opportunities, stole a HELOC, a second high rate second card, excuse me, a high rate second mortgage from a competitive organization, redid the car loan that they had with him, and picked up his Visa card. Credit union picked up $37,500 in new loan balances and $1,000 in interchange income from his checking account that he brought over as well. Well, that's cool for the credit union, but how about the member? By redoing his loans, they reduced his interest rate and interest cost and enhanced his credit even further. Do you think this member is very, very happy, loyal to this credit union? Think he tells everybody he can about what a great place it is to do business? This is credit risk. This is learning to differentiate, not just go after the A+. By the way, a large percentage of Henrys come from A+ borrowers. Okay, so let's talk about expended risk. Because we have to do these two things in hand. We want to expand out, like NCUA says, and offer loans that we otherwise would have avoided, get away from 92% of loans being A+ and A loans. But now we want to talk about understanding setting those rates appropriately. In their guidance letter, NCUA says the key, not a key, the key to successful risk-based lending is to ensure that prices, the rates that you charge, correctly reflect the risk and costs involved. What does that mean? Well, this is expended risk. This statement goes to the heart of expended risk. Do you understand what the exact risk of loss is? And do you understand what the true total costs are that you have incurred in making these loans? Our analysis and our tools that we provide for this were based on a statistical analysis trying to differentiate, and we found that there are 4 distinct sets of costs that must be addressed and included and measured in an effective cost pricing system. The first is cost of funds. We've already addressed those. We've talked about that. That's the cost of the raw materials. Sure. Loan operations, salaries, benefits, computers, phones, office space, all the different tools, the computer systems and whatnot that are used to run and operate your loan department so that you can underwrite, decline and approve loans and fund loans. That all goes into here. How are you paying for that? The next is collection expense. Collection expense is a real cost. Sometimes it's employees on your behalf, sometimes it's consultants, contract firms, and sometimes it's attorneys. But that collection expense needs to be covered as well as charge-offs. Now, charge-offs, that's the extended risk we talked about earlier, but it needs to be included in this cost analysis. We need to identify them, accurately measure them, apply those costs to loan volume, and then set rates that cover those costs based upon the volume that you're experiencing. So I'm not going to spend a lot of time in here. Cost of funds, you know what that is. It's your interest expense divided by your average deposit balances or ending deposit balances, whichever way you want to do it. Calculation results in a yield. Okay, that's pretty straightforward. The next is operational costs. But consider this: salaries, benefits, computers and software, office space, furniture, equipment, supplies, dealer costs. This is just a starting point of the operational costs that are included and incurred. And you write hard checks for these, money that flows out of the credit union to make lending possible to produce loans at your credit union. All these costs must be included. We suggest that in order to do it effectively, you need to account for, we do an effortization where we include new accounts, because you have employees in new accounts, transactions, which is those deposits and withdrawals and checks written in ACH and ATMs, all of those things, consumer loans, mortgage loans, and commercial loans. If you don't break out total costs for all these areas, you are likely to overlook costs that directly impact what's going on with your lending. Collection expense, these need to be broken out by loan type and subdivided by grade to look at where those costs are and apply those across your loan portfolio. And it's important to look at an extended period to normalize the actual expense. Sometimes it'll go up a little bit, down a little bit, but over the life of a loan, you need to normalize that. And finally, charge-off expense. This, again, needs to be broken out by loan type, but also subdivided by grade. What is the loss rate for A plus and A, but also what's the loss rate for C, D, and E, differentiated. And those need to be tied into your expected loss on your allowance. Well, let's just take a look at an example of this. Here we have a credit union that spent in the most recent quarter. This is information pulled directly from the 5300. $145,000 were spent operating and maintaining their new accounts function. New accounts being opened, accounts being edited and updated and changed, as well as all the overhead and maintenance that goes there, plus support and administration. We've got to include the CEO, the CFO, any of those administrative officer costs. Those have got to be included as well, and they are in every one of these. They spent $563,000 operating and maintaining their transaction area. ACH, ATMs, all the things that go into members putting money in and taking money out, and the credit union paying its bills, all the accounting that goes into there. Consumer loans, $349,000. And mortgage loans, $171,000. These four numbers here cross-foot perfectly to the 5300 of this credit union. Now, go one more step when we say they opened 546 accounts. Remember, they spent $145,000. They opened 546 accounts. On average, then, it cost them, or they spent $639, almost $640 per new account. That's the cost that they spent. Excuse me, this is not new accounts. Bear with me. I was just looking at this saying, boy, that's wrong. This is $639 per new loan. Silly me. $639 on average for every one of the 546 loans that they made. That's the 349,000. Let's get that right. So 546, 639 per loan. If we have irrationally low interest rates, then it is likely that we are not going to collect $639 per loan. We might only collect $200 or $300 per loan. So we spent $639, we collected $200. That is what leads to the need for $12.2 million of fee income to cover the operational deficiency, the net of the credit union. Now, down here in mortgage loans, they did 14 loans. You can see now why there's initiation or origination fees for mortgage loans. But if we're not charging adequate interest to cover this cost, then we're going to have a net fee subsidy, no question about it. So let's talk about steps to eliminate net fee subsidies. What do we do about it? We now know exactly where it comes from and why it happens. What can we do about it? Well, let's take a look at some costs. Here we have a cost breakout of the credit union we were looking at earlier. Notice their cost of funds is 40 basis points, and that's equal across all. There's no difference in the money we use to make a D or an E loan versus the ones we use to make E plus an A. However, the time it takes to do an A plus or an A or a B or a C or D loans differs. And our time and motion studies suggest that there is a significant difference in the amount of time and resources that it takes to put these higher risk loans on the books than with A plus that are sometimes automatic. So you can see that the cost that came from that report. Let's just look back up here real quick. This $349,000, when it's spread across these different grades, we need 133 up to 2.21 to cover that expense. Plus collections is included in that. And again, we spend much more time following up with these folks than we typically do with these folks. Differentiate. Remember we said differentiate that across the rate. And here, this credit union has very little loss. Of course, A+ loans are A+ because they pay. And E loans aren't because they tend to have credit problems, slowness in the credit rebuilding. Now, Henry's are going to end up here. John's may start here, but are going to end up here. So if we total this all up, there's 2% cost. Now, if this credit union is offering a 1.99 A+ rate, you can see that they're barely breaking even. And if they're offering a 1.99 on this, they're going to have loss. They're not even covering a margin, no margin at all. So if we're not taking into account these costs, it's very easy to create a net fee subsidy. So if you can see here that they're talking about what those anchor rates are. So if we take 2 plus a proposed fixed margin of 2%, then we should be charging somewhere around 4%. Okay, so you want to charge 3.99? Great. That means we've got a 1.99 fixed margin. And the other thing we want is to make sure that our margin is increasing as the costs increase. We want a consistent, fair, comparable rate of return. Okay, with those costs, this credit union has said we're going to charge, and this is one of the things we typically see, we're going to charge $399 here and $499 for 5 years, and that's going to give me a 2% margin. That's great, but we're going to charge $16.59 for D and $17.99 for E, which gives them these extraordinarily high margins. Notice here, costs is 2%. They're charging $399. That's a $199 margin. This is the anchor rate, which includes the costs. Here's the actual rates that are being charged. Here's the margins. But the problem is they have tight underwriting criteria and a very unattractive rate. Look at those margins. Huge. Well, they'd be nice if anyone was interested in taking them, or if the underwriting was appropriate that allowed people to take them. But they've only got 4% of their entire loan portfolio in these 2 grades, and only 5% in the C. Notice they've got 72% of their loans have margins of 2% or less. These higher margins down here are worthless to them. Essential, worthless. What that results in by weighting these out is a 2.63 weighted spread on 4-year loans and 2.72. Well, let's take a look. If we make $1 million of these loans right there, and we distribute it based upon these percentages, this credit union will generate $52,000 in revenues, have $25,000 in costs. That's the total here. So we take those percentages that we had in the anchor rates, multiply them times these balances, and it actually shows us what we're setting aside to cover the costs. The profit's going to be $26,000 a year. Is that adequate? Now, what if we go to the next step? What if we were to lower the rates? Lower rates? Are you kidding me? We're going to leave the A+A, B, and C alone and bring down the rates that we're charging. See, those are all staying the same, but we're going to bring down C, D, and E to margins that are a lot more appropriate and a lot more attractive. And when this credit union did this, notice that their percentages increased substantially in the C, D, and E ranges. Now they've got 8%, not 2%. Now they've got 10%, not 2%. Now 12, not 5. As a result, their weighted average spread increased to 3.84 and 3.94. Let's take a look at the impact. We have lowered rates. Our revenues increased to 70,000, excuse me, 70,000. Our costs increased slightly to 31,000, but our revenues, net revenues, increased to 38.9 or almost $39,000 per year per million. And notice down here in the charge-off area, for the C, D, and E, we're setting aside over $5,000 to cover potential losses on this specific $1 million. And there's not a lot of numbers in here. Okay, so an enhancement. Now, what if we go one more step? We leave the rates exactly as they are. These are the rates we're going to do, but we employ that decision tree varied guidance we did about underwriting. And we actually look for John and Liz, newbies, and encourage more individuals with improving credit scores to come to us and help them to rebuild their credit. When this occurred, they went from 8 to 10, from 10 to 15, and from 12 to 15. Not huge jumps, but significant, noticeable. The yield average spread, weighted average spread, increased to 4.3 and 4.47 without lowering rates. And notice here, just going to go to here, we're putting aside $7,000 for charge-offs and covering collection expenses here. But now we collect almost $79,000 per year per million. And our net revenue is 43, almost 44,000 per million per year without changing any of the rates. Let's just compare this. Our first example, we had $52,000 of revenues, very conservative, risk averse, avoiding those problem loans. Oh, wait a minute. And so we said we're supposed to actually look for ways to make those problem loans. Just avoid Henry's, focus on John's and Liz's, 26,000. When we actually lowered rates to make them more attractive, we increased from 52 to 70, and from 26 to 38. And when we enhanced our underwriting, addressing extended risk, we went from 52 to 78 in gross revenues and from 26 to 44 in net revenues. This is a strategy that works. It has worked over and over again with credit unions. And notice this number here, right here, is per million. So in a $75 million credit union, gross revenues will increase by $1.3 million. See those comparisons there. This is gross revenues, 52 to 70 to 78 by $1.9 million. And net revenues will increase by $1.2 million. Now remember early on, we talked about credit unions losing $1.8 million, $1.9 million, $1.2 million in revenues. A $200 million credit union, let's say 150, by doing what we've just said, can add $2.5 million to their net revenues. This will make a net fee subsidy disappear. Now, a couple additional considerations. You may be thinking, but there's so much more risk. There's just so much more risk. Let's just take a look at this as a comparison, hard numbers. We've got loan balances of $1 million. This group is all high low risk, low yield, 2.99 interest rate, highest credit grades, that $1 million is going to generate $29,900 of revenue. Now, I'm just talking about extended risk at this point. We've already looked at expended risk. We got to generate a lot more than that to cover operational expenses, but just from an extended risk standpoint, $1 million here is going to generate $129,900. Okay, there's the differentiation in revenues. Now, let's just consider that there are absolutely no losses in this group here. That's the $1 million at 2.99. If we have a 4% charge-off rate, so we lose 4% of all the dollars in this $1 million, that's $40,000 of charge-offs, which will bring us from 129 down to 89.9, which still gives us $60,000 of marginal revenues, increased revenues over the $1 million at 299 with no losses. If we have a 6% loss rate, that's $60,000, which gives us $40,000 higher than the 29.9 that we would get with no losses here. So we've talked about expended risk, but we also show that the extended risk, by taking a diversified risk, by diversifying your loan portfolio appropriately with specific parameters, and by pricing based upon those costs, just as NCUA suggests, really does work to the advantage of your credit union. Let me just show you some examples. In just 1 year, there was a 16% change on this $27 million credit union, adding 44 plus to their bottom line. A $79 million credit union or loan balances went from 5.5 to 5.8, 31 basis points, added 247,000 to their bottom line net revenue. And here, from 5.48 to 5.62 on this $137 million portfolio, added just under 200,000 to the bottom line. This is how we make net fee subsidies disappear. Even tiny credit unions saw substantial improvement. Well, if you'd like to know more, we'd be happy to give you a demo. Please don't hesitate to contact us here, Donna Jensen or Randy Thompson at TCT Risk Solutions. This is our website. This is my email address. And I appreciate so much you being here. I hope that you have a great rest of the year. And thank you very much for your attention and for listening in as we talk about this, what I believe is a very important topic.